Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, May 6th, 4:54 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at key levels for next week, and normally update the 21 over 21 leaders list, but there really are no leaders that we want to be actively monitoring for purchase immediately as we're mired in the depths of a correction. So instead of the 21 over 21, we're broadening the list a little bit, and it's going to be 40 stocks, and I'm going to call it the Fab 40. And if you'll notice my voice going up at the end of that, it's a question, not a statement. That's a hat tip to Ron Burgundy, who would read anything off the teleprompter, and if you put a question mark at the end, his voice would go up. If you haven't seen that movie, I don't know why you haven't seen that movie. I recommend it. So anyway, the Fab 40 is what we're going to be reviewing tonight. So, state of the market correction. It's not news to anybody that's been following us. You can see over here on the trend gauge our leaders indicator, and also our short-term, medium-term, and long-term indicators are all flashing bearish / downtrend. There really is no market leadership to be found, and all 5 of the major indexes are below these key levels: the short-term 21-day exponential moving average, the medium-term 50-day moving average, the long-term 200-day moving average. As far as what just happened today, new year-to-date and correction closing lows for the S&P 500. Can see the numbers here. G6. This indicator, if we weren't looking at anything else and we just looked at how this has been acting, will keep us miles away from buying growth stocks, because there's no leadership in growth. These continue to underperform pretty much every index under the sun. G6 down 2.36%, S&P down 0.6%, NASDAQ 100 down 1.2, Dow, the leader of the day, down 0.3, mid-caps down 1.3, Russell 2000 small caps down 1.7, diversified global 60/40 stock bond down 0.79%. In-house, we were positive on the day as we booked some profits in our short when the market was trending lower in the morning and held at a key level. And also our inflation protected short-term bond ETF that we're holding was also positive on the day, as opposed to the big 3 regular bond ETFs, TLT, IEF, and IEI, that we track, all down on the day. And the key is the inflation protection, not the bond. Bond prices are at highs. Bond yields are at highs. Bond prices are at lows. Stay away from normal bonds, but inflation protected, you can find, especially only in short term though, you can find some current alpha versus the overall bond environment. So let's get to the tail of the tape. Let's dive into the charts. But first, let's take a look at the team here at Revere. Trend following. That's what we do here at Revere. If you're interested in this approach where we participate in market uptrends, get out of the way in market downtrends, and protect sideways, we take our foot off the gas. If you're interested in this approach, I got distracted there for a minute. Give us a call. Email any of us if you want to. Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So now let's get to the charts and the tail of the tape. Start out tail of the tape. The headwinds continued. With the Fed meeting on Wednesday, we got a very strong short squeeze that looked like an attempted rally at the time, promptly failed badly on Thursday, followed through the downside on Friday. So these headwinds continue to wreak havoc with the market. That's a strong US dollar, inflation, the Fed taper and balance sheet reduction, rising interest rates, and Russia-Ukraine. Put call is elevated, but has not spiked to where you could have any confidence that a bottom could be put in at 1.15. VIX, same thing. It's elevated, but haven't seen a spike. Fear and greed, showing fear but not extreme fear. Our bull case, reclaim of 4,200. This lasted 1 day on 5.5 before we broke back below it on Thursday. So we're working under the bear case. First thing we need to do to have any hint of a rally is get back above that 4,200 level. So jobs report this morning, a little bit of a benefit, plus 428K versus 400K expected. Didn't seem to, the market popped before hours at first when that came out, but then faded into the close. So coming in today, what we're watching, how would we do if we hit overhead resistance at 4160 to 4200 and we tested it and failed? Really, this range has been shortened up to 4150 to 4160 is what's been acting like resistance more recently. Support, the low of the week, 4062. We tested that and held. Low of the day was 4068 on the S&P. So a small glimmer of hope there. So still keeping our eye to see if we have this third leg down panic move under the 50-day like we did in January 24th and February 24th. That level's around 40.23. So we got less than 1% away from that today, but really you need to see it, hit it around 8, and then you need to flush to really 9, 9.5, or 10%. But if we get to the minus 8%, we'll start paying more attention to it. Follow up from our last valid 21 over 21 list. Have any of these that were can be considered guideposts for the market? Are these holding? And for the most part, what you're seeing is oils holding, select healthcare stocks holding, and defense names holding. For example, healthcare, Lilly holding, General Dynamics holding. Caterpillar keeps going back and forth around its 50-day moving average. Mosaic, same thing. CF is holding, but anything that was tech related, like PanW and Crowd, these have failed miserably. CCJ has failed badly, and steel stocks also, which had recently been a source of strength in the market during this past leg up and held up well for a while during the pullback. They seem to have given it up. Action today, the gap down I mentioned. Well, I didn't mention it actually. We gapped down 0.5%. Went and tested the lows right out of the box, bounced there to positive on the day. Were we going to see a slingshot higher? Nope. We consolidated, we faded, and then a little bounce late in the day. And as I mentioned, 4150 to 4160 seems to be a new resistance level. Let's take a look at the S&P on a 15-minute chart, and you'll see what I mean here. Here's this 4150 level, and you can see for Tuesday, Wednesday, and Thursday, this kind of played a key role as support on pullbacks on Tuesday and Wednesday until we broke higher, and then we came down, bounced there momentarily on Thursday, then broke below it, and now 2 attempts at rallying up into 4150, 4160 failed. Actually, 3 attempts failed today before we rolled over, and then a little bit of a bounce. So keep an eye out on this 4150, 4160 level next week. Should we get above there, then we want to see what happens if we get into 4200, which, as we know, has been a battleground repeatedly for over the last several weeks. Strong today. Oils, gold, staples, utilities, and select defense stocks. The ETF ITA, which is aerospace and defense, looks awful, but select stocks look fine. General Dynamics, GD, NOC, Northrop Grumman, NOC, Northrop Grumman. That looks probably the best of the bunch. Lockheed Martin, holding up fine. What did I miss? Oh, Raytheon, RTX. not so good. This is one of the that used to be the Fab Five, but this has given way, as well as LHX has given away. So we're down to three that are holding up. Definitely holding it, bounce at the 200-day, but look at this candle on its earnings. My gosh. But it did bounce at the 200-day. But those three, General Dynamics, Northrop Grumman, and LMT, are the three big leaders in that group. Let's go to back to the S&P 500 chart. So you can see here, here is the somewhat of a spike low on 5/2, which was Monday. So we're wondering if we put in the low, we put in a higher high on Tuesday, big rally on Wednesday, but where after the Fed, particularly, you can see that on the 15-minute chart. Here's the Fed immediate shakeout, and where did it hold? 41.50, and then blasted off all the way up to 43.07, which was also just the high from April 28th, and that's it. Overnight, we gapped down, a lot of hard selling Thursday morning. And really Thursday was, I think, the second worst day of the year for the S&P and the worst day of the year for the NASDAQ. So a little bit of digestion with a downward bias today on Friday. Let's go to the NASDAQ 100. The Q's weaker than the S&P. You can see the relative strength. Really, this topped from a relative strength perspective at the end of November, and with a brief respite in March for this rally off the bottom. It's from a relative strength standpoint and a price standpoint, it's been making lower lows. So not good for the NASDAQ 100. The Dow, on the other hand, has been a relative strength leader, but not a price leader. You can see the relative strength line here continuing to trend up. Let me shrink this down to see if we can get the whole thing in. No, we can't. All right, so a little bit of a problem there with MarketSmith and the relative strength, not completely showing it, but trust me, it's holding up better. It's down, I think, 9% year to date versus over 13 for the S&P, over 20 for the NASDAQ, about 18 for small caps. So, but it also, very similar pattern, failed at the 50/21 on its bounce. Did hold, didn't make lower lows for this week, and also held the lows back from 224. Let's go to mid caps. You see this big area of support around this 450 level, coinciding with the 124 low, 224 low, and the lows of this week. Undercut it and bounced today on Friday. Let's go to small caps. Undercut and I don't think closed above the lows, so bounced at this 180 level, but you can see these also, small caps also topped out at the beginning of November and have been also trending lower. During that March rally, small caps underperformed. It was really just the big NASDAQ stocks that had money flowing into them before they rolled over at the beginning of April. So those are the big indexes. Bottom line, well, let's talk about portfolio. The portfolio, we closed our short for a small gain. Our beta is basically flat. This VTIP short term has a negative 0.01 beta. Multiply that by 10%, and we've got a very light exposure to the market. It might as well be zero, so we'll be up some days, down some days, but it does have a 5.5% yield. And bottom line, new year to date and correction, closing lows, S&P down 13.5% year to date, and something's really got taken apart today. XME, software stocks, cyber stocks continue to just get punished. Biotech, retail, and JETS, jets, also getting pummeled. So that's our story on the indexes. Let's go to the Fab 40. And what we're going to do is go through these very quickly. I think there's 15 sectors and 29 different industry groups, and we're sorted by how far we are above the 21-day simple moving average, not the exponential, because that's the simple is what the chart uses. So we're going to go from strongest to weakest, and I'll point out ones that stand out to me in particular. Livent Corp, this is one that really stands out to me. Had a gap up on earnings, and it's holding. This is a lithium stock, and lithium had a good week. If we ever get growth back and EV stocks and the components of those come back into favor, I would expect this to be a leader. CC, this is a new one, the Chemours company. It's a chemical stock, and gap up on earnings, higher high, and pulled back and held the pivot. So anything that's acting like that, you got to pay attention to it. Haven't really researched the company, but the numbers are good, and especially trade with a PEG ratio of less than 1. You got to pay attention to those too. AMR, coal stock, making new highs. Zim coming back, forming a base. Back above its 21 and its 50. That's good. This is when it's been acting well. This has been a serious leader. It peaked when it had a big dividend paid back in mid-March, and now is forming a base. And there are several other shipping stocks that are going to be in here too. Devon Energy. I could probably find 100 energy stocks or more to put in here. I'm just going to highlight a few of them though. So Devon, we've owned this in the past, making all-time highs. Mattel. Toy stocks had a good week. This is a gap up on earnings, flag for 3 days, follow through to the upside, break out, pull back to the pivot. If this was a typical market, this is a stock that you would want to own. OLN, fairly new, another chemical, gap up on earnings, broke out of its cup and handle, pulled back to the pivot. Again, that's a very nice formation, very nice cup and handle. Occidental. Buffett's buying it. If it's good enough for Buffett, it should be good enough for anybody else here. 5 straight up days. Earnings next week. Nice bounce off the 50-day moving average. Arch Coal, another coal stock, acting well. Great reaction to earnings, continuing higher. GOGL is one of the other shipping stocks that's in this list, near all-time highs. AMCR, containers. I guess Amazon shipping everything. Well, let's see. There's food flexible packaging products and pressure-sensitive materials. I don't know if Amazon uses them, but they sure as heck use a lot of boxes. But anyway, base on base, stage 1, gap out of it on big volume, pulled back just to the pivot. That's what you want to see. It's liquid enough at 9 million shares. We don't normally look at $13 stocks, but it does trade $9 million. And it's a defensive stock, not aerospace and defense, but a defensive stock, and that's what's working. Also working, ExxonMobil, up from its cup and handle, pulled back, held the pivot back above the pivot. This one looks fantastic in oil land. Excuse me. Another transportation shipper, Star Bulk Carriers, holding the 21. LNTH, this is another one I'm paying attention to. You can see from this gap 2 earnings ago, they've got a new technology, gapped up again from this base on earnings, flagging now. If this was a healthy market, I would own this. MCK, big move today on earnings with above average volume in the medical sector. IBM really hasn't done anything since its earnings gap up. I don't know if that was short covering or what, but it's still kind of working on its base. Kimberly-Clark, big gap up on earnings, pulling back since then, holding its 21. AT&T, best thing you can say about it, it has a nice dividend, and it is forming a cup and handle, although the 21 and the 50 are still below the 200, but this is kind of where money's flowing with its beautiful 0% earnings growth. CVX, Chevron pulled back a little bit after earnings, now reclaiming the 21. Northrop Grumman already showed this. Nice pattern there. Kraft has recovered from a dismal performance over the last couple of years, forming a big cup and handle that it broke out of. Merck, very nice cup and handle. PKG, another packaging, paper and paper products, outperforming the market. As you can see, nice reaction to earnings. 21-day controlling all of its pullbacks. Hershey, who doesn't love chocolate? But when you own stocks like this and they're outperforming, and then you get a day where it's down 3.7%, like on Monday, it's just better not to own stocks in a market like this. I'm showing what's holding up. Some of these may turn into leaders. Some of them will lag because they're just defensive, and if money comes back into growth, it's going to come out of these. But like you own Hershey, you're feeling good, and then you give up 4 weeks of gains in one day. So no reason to be a hero. Lilly, this is holding up extremely well, not very volatile. Held the 50 on every pullback, back above the 21 now. EQT, another oil stock, holding the 21 after a nice move up. WM Waste Management gapped up on earnings, pulled back to the 50 and 21-day moving averages. Coca-Cola bounced off the 50-day moving average after its earnings. I personally prefer PEP because of the Frito-Lay component. McDonald's making a new relative strength high, although price is not. That's just defensive fast food. General Dynamics already showed this one, acting okay. Tech pulled back but recovered. Harsh pullback here. And again, holding things in a bear market that are holding up and look great, awesome. And then boom, 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 3 days from 44 to 34 before recovering some. Here's Pepsi that I talked about, holding the 50 but below the 21. Dollar Tree bounced off the 50 today. Caterpillar back and forth around the 50-day moving average, but decent peg ratio. Halliburton climbing along with the 50-day moving average. Delta, the leading airline, but broke below the 21 this week, but held the 200. CF, this has kind of taken a leadership versus MOS, which we owned and sold yesterday. TMUS, forming a cup and handle, playing back and forth with its 21 and 50-day moving averages. SLCA, sand stock for fracking, holding the 50-day moving average. And finally, Avis, big numbers on this, pulled back below the 21, held its 50, nice relative strength, massive numbers for a PE of 8, and that's going to wrap it. Let's see if there's anything else in the tail of the tape I want to cover. I don't think so. So let's go ahead and wrap it up. So as always, love to hear feedback from you. Email don@revereasset.com or phone 855-REAL-WEALTH. Finishing up a bearish week. We actually weren't down much. Let's take one last look at the S&P on a weekly basis. Weren't down much for the week. It was a wild, volatile week where we tried to make some moves higher after the Fed gave it all back on Thursday. This is typical bear market action. And then making lower correction lows. So closing the week ending Friday, May 6th. This is Don Vandenbord telling it like it is. Thanks for listening. Have a great weekend and happy Mother's Day to all the mothers out there.